2008, I remember it well. So do you, I'm sure, as well. I remember talking to you at the time. It was brutal. You say this reminds you of what we went through then. Why?
Heavens, well, you had Spitznagel yesterday and you've got Eclectica Hendry today. I'm afraid it's the same thing. I want to raise the stakes. I actually fear this could be more severe than 2008 because we may have muted the ability of the Federal Reserve to underwrite a binary situation. In March 2009, just before the advent of quantitative easing, right? Yep. Citigroup traded, I think, at $9, which was the same price as prevailed in the 1970s. But $9 was $9 too much. It was bankrupt. The system was set to reset to zero with the bankruptcy of the global financial system, and the Fed underwrote the financial system. Or I would say, as an agent of all of us, it underwrote the financial. Will it be able to do so again? This market wants that question answered. And like Mark said, this market is going to go, it's like deep sea diving without air, is going to go to a depth below the surface, probably in that 30 to 50% below the all-time high, and it's going to wait and it's going to say to the Fed, what you going to do?
And what will the Fed do?
Well, do you know, it's what the Fed is doing now, which is the concern, because they're not listening to, heavens, what was it? It's, what's he called? Lao Tzu, the mythical Asian philosopher. And he said, treat the world as you find it. Don't interfere with it. Accept it. Okay. Now, what do I mean by that? I mean, bubbles are fine. They're not fine, but they're kind of sustainable as long as there's there's zero financing. But the Fed has become aggravated and it's changing carry. Mortgage rates in America have doubled to over 6%. We're seeing various credit yields blowing out. We're seeing drama in Italy. We're seeing drama in the foreign exchange markets. In the most unsuspecting places, like the solidity of the yen has just slipped like sand into the sea. Okay, why? Because the Fed is tampering and is calling upon the spirit of Volcker from the 1970s. Why is that? Why could that be catastrophically wrong? Because the 1970s was 40 years after the bankruptcy of the US financial system, right? And we had 40 years where we deleveraged and global debt was like 1 times GDP. Today it's 5 times. If you raise rates, the whole edifice of this system could crash.
To Mark's point, there's too much dry tinder out there. If you light the fire, how fast does it burn?
Absolutely. This is all about, it is, profound market turning points are always about collateral, always about the undermining of confidence in collateral. Collateral is money, okay? When you start raising rates, the ECB, remember the ECB are rather blind. These are the agents who raised rates in June 2008, yeah?
Tricher.
Tricher. The verb tricher is to lie. Make of that what you will. They certainly couldn't see the future, okay? They just raised rates, 75 basis points last week. Consequences, okay? Consequences. Back in 2012, when Draghi said, BTPs, we stand behind them. 10-year Italian bonds are the equivalent of boons. The problem is the German government doesn't produce enough bonds, and bonds are money. And so what happened is the euro-dollar financial banking system, the system that creates and prints money across the world, decided to use BTPs. This is analogous to the global banking system using mortgage-backed securities as collateral, with the conceit and the arrogance that this was a great idea until it wasn't. And what we're discovering is if the ECB insists on 75, the confidence in using BTPs as collateral across the world will be called into question. It is being called into question. The reason why the dollar is surging versus the euro is at the margin. Banking counterparties are tapping their neighbors and saying, please take the BTPs back. I need dollar treasury bills. So at the margin, what's happening? You're selling euros and you're buying dollars.
So Hugh, first of all, it's Alex in New York. It's really great to see you. You're really bumming me out on the picture that's going to evolve. Where's the biggest misprice then in the market if we're looking at this kind of huge mistake that's going to just wreck a lot of assets?
The market's a genius, yeah? Yeah, I never set out to outperform the smartest minds on the planet. They're smart, right? So it's got it. How could I play this, right? So if we approach this, if any of this comes into play, you want to be long volatility, right? That's really, really hard. So you've got to be creative and think about it, okay? And I have. You know, I sit on my island in the Caribbean, and I think the cheapest source of volatility can be found in the cross rate between the renminbi, or that is to say the Chinese yuan, versus the US dollar. And even then, it's not that cheap because implied, i.e., the pricing structure built into the price of future movements is higher than realized. So you're talking call spreads, but like a call spread, $7.30, $7.50 CNY is a source, I believe, of getting long volatility. And if anything, any of this happens, boom, you're going to make money.
So, boom, you're going to make money. A lot of volatility. I get that. Are central banks, and I think more importantly, and to some extent, policymakers, going to allow that kind of volatility?
Let me, I am here. I represent to you and to the world the five. There are no more than 5 people who understand money in the world. And I assure you, they do not work for central banks, and they do not work for investment banks or hedge funds, okay? When the poor monarch of the United Kingdom, the departed Queen, in 2009, with visiting dignitaries, she said, with all of this genius, why did no one see 2008 coming, okay? Because no one knows the identity of the 5.
Who are the
I
5?
do, and
Who are
I'm
the
here
5?
That's for, hey, listen, yeah, I'm here giving you cheap sources of volatility. That's for people to do their own homework. I have made a vow of trust never to reveal. But let me tell you, you walk past them every day. They surf. They have long hair. They certainly don't wear suits, and they're controversial.
Okay.
So, yeah.
You paint a picture. Sorry, Alex.
Oh, no, I was just going to say, so, but if that's the case, then you're implying that, yes, policymakers and central bankers are just going to make a lot of mistakes that contradict each other. Is that like what I'm going to take away from that point about the 5 smart people?
Central bankers do not understand money. They pretend. I ask your audience, tell me the last time the Federal Reserve got it correct, or any central bank for that matter.
Yep.
I don't know. They get things wrong. And now there is a conceit. This year began with 2 consecutive quarters of GDP contraction in the United States. What is the response of the Federal Reserve? It's not a recession. I'm getting on in years, and for as long as I've been on the planet, guess what? It's a recession, okay? And they say, no, wait until the wise economists at the NEBR confirm it. I dare you, wait. Because if you look at the charts, the S&P is typically down 50% when the wise guys get it.
How do you think about QT? How do you think about the liquidity squeeze that is coming?
No, may I repeat myself?
No,
Private banks create money through collateral and taking reputational risk sharing with their neighbors, okay? Quantitative easing. QE did not generate inflation. Let me quote.
No, but it created liquidity.
It created liquidity. Okay, so the Federal Reserve.
So what happens when we reverse that process?
The Federal Reserve has studied this. There is a recent Federal Reserve paper which maintains that a $2 trillion reduction in the Federal Reserve balance sheet would be equivalent to 27 basis points of hiking. Okay. It's a joke, okay? It's a joke, right? The greatest danger is the unwinding and the lack of confidence in collateral. The big event is, look at the yen. Heavens, the yen's at 25-year lows. Why? Because Japanese money center banks are not interested in lending into Japan, the moribund economy, right? They have become the Asian distribution platform for dollars into China. That is to say, they're short dollars, they're short treasury bills, and they're long duration commercial risk within China. And what we're seeing in the currency isn't hedge funds, it is banking counterparties across the world saying, get me out. I urge the audience, look at 5-year CDS for Mitsubishi UFJ. You'll see something just beginning to wake up. But when the risk officers at the largest global banks in the world seek to reduce their Japanese bank exposure, they're going to buy that CDS.
What is a safe asset?
There's no such thing as a safe asset.
What is the safest asset?
No, it is the safest behavior.
If you want to hide out, people are beginning to get worried.
Yeah.
Galileo starting to get worried. People are starting. Okay. People are starting to get worried. Where do they put their money? I remember 2008. I remember 2008 in particular. Where do you put your money in that kind of environment? Where do you, if you're not buying volatility, where are you putting your money?
Guy, this is, again, I've been around way too long, okay?
Okay.
Between the NASDAQ crash, March 2000 and 2002, the German stock market fell 80%, the DAX, okay? I made 3% in a mutual fund. My competition, the other mutual funds, sought to have me debarred. Why? Because in answer to your question, desist, walk away. The hardest thing you can do,
exactly.
Walk out of the casino. Again, I dare you. Is the Bible says for a rich man to enter heaven. It's like that.
You walk out of the casino, then what?
Wait.
You just put it in the bank.
Wait. I don't care. Just don't. Like put it in your pocket. I don't care.
Right. But don't invest in assets.
Don't take risk at this point. That's the gamble, right? Maybe wrong, okay? But the thing is, okay, the call is, will the Fed buckle? Probably. Will we make new all-time highs if inflation is at 7? We don't know, okay? So are we in a redux of the 70s stock price performance, which was an excruciating trend with a ceiling on the price? You get to the high, and people would buy for the breakout, and you go to the low. And people would sell for the breakout, and you go back to the high. Maybe. But, there's too much drama before then and now.